video, we are only going to talk about the impression management of corporations. Through negative descriptions of financial reports, management and controlling affects people's views on companies' financial situations and operating results. The motivations can be listed as follows: truthful going for shrewd conduct, pursuing expand anticipated returns, and limit anticipated disciplines. People invited to ensure their open images are steady with their social status. Strategy can be divided to two categories: negative and accounting, excuse and justifications; positive and acclaiming, self-enhancement, ingratiation, and literature words and description. Earning restatement is a way managers to use to disclose financial statement after appropriate adjustments. Main motivations are to attract investors, to maintain their share price, and retain a series of positive earning growth. There are some methods that they tend to use and engage in earning restatement: reducing provisions, changing cost of inventory measurement methods, using big box theory, asset restrict, changing accounting policy and estimate. Financial restatement often lead to serious consequences. The shares of financial restated company fell sharply. Investors lose confidence in companies after restatement. Correction of significant accounting errors may lead to joint and private litigation and other economic consequences for enterprises, such as raising information risk, decreasing expected future return, and so on.
Why engage in earnings restatements? Inspection from regulatory departments, as well as internal control defects, are usually the main reasons for a company to act on earnings restatements. Internal motivations make investors build confidence. The stock price will fall when the companies face problems due to negative profits or decreased net asset per share. Hence, managers tend to use earnings restatements to make the books look profitable. Technology improvement may also lead to an earnings restatement. Managers' personal gain. Compensation contract helps to make the interests of managers and owners converge, but compensation contracts can also induce managers' self-serving act, harming the interests of shareholders. Promoting the listing of enterprise before listing. In order to meet the requirements for listing, many enterprises use profit manipulation to make the company remain high profit. Tax purposes. There are two advantages for companies with lower tax rates. First, lower tax rates in the future and less income tax required. Second, the time value of money can be earned by deferring the payment of income tax. Changes in accounting standards. For example, earning figures may differ if a company uses FIFO instead of LIFO, since the goods bought later may be more expensive. Let's move on to external causes. There are limitations in the audit process. This risk is inherent in the audit process and cannot be avoided artificially, and may lead to the formalism of the audit of financial statements. Complexity of accounting. The different measurement methods of assets increase the subjective of the personnel's choice. Due to that reason, these non-uniform calculation methods provide space for the use of earnings management.
Now let me show you the analysis of the company. The company we choose is a Royal Dutch Shell. The background of the company as follows. Since January 2004, Royal Dutch Shell has reduced its oil reserves by 20% for the first time, admitting that it had been overstated. Although the company reduced its reserves since January, Shell's executives had already known that it was an overstatement of its reserves and it sent a dishonest message to investors. According to a survey, Shell announced again to lower its oil reserves by 103 million barrels until May the 24th, 2004. It was the fourth time that the company reduced its oil reserves, and a total of 2.47 billion barrels of oil reserves, which was originally reported as proved reserves 2 years ago, had been reduced with the cost its proved reserves to wander around 11.5 billion barrels. Crude oil reserves alone fell from 6.6 billion barrels to 4.6 billion barrels in January 2003. What's more, Royal Dutch Shell has rapidly restated its financial statements, with the biggest revision being its 2002 year's profit, which was inflated by $208 million due to improper accounting practice. In addition to questionable reserve accounting, there were some errors in the way items such as exploration cost, certain gas contracts, and the parent company's earnings per share were recorded. Shell's findings showed that 100 of the company's 300 largest fields are at risk of being infected. By the end of 2000, within 3 years, Shell found new reserves only equivalent to 60% of its existing reserves. But Philip Watts, head of exploration and production, boldly reported a 3-year average rate of 102%.
There are several serious consequences shown in the slide. After months of external pressure from investors, rating agencies, and regulators, the oil group began to push for a complete restructuring of Shell, including a full merger, to restore the company's credibility. Sir Philip Watts, the Shell's chairman of the board, along with Judith Boynton, the CFO of Shell, and Philip Watts, had made an apology to the shareholders as well as the public, and finally decided to resign in March 2004. In June, Shell hired Peter Voser, who had successfully helped ABB out of difficulties as the CFO. On August 24, 2004, the Financial Services Authority and the Securities and Exchange Commission announced their final agreement with Shell, respectively as a result of earlier false claims of oil and gas reserves. Under the agreement, Shell agreed to pay huge fines of £17 million to the authority and $120 million to the Commission to resolve and support the two institutions' investigations into the oil and gas reserves.
These are the techniques used by the company for impression management. The first technique, apologize, admitting responsibility of the undesirable things, seeks to get pardon. The evidence is the Sir Philip Watts, the Shell's chairman of the board, the Judith, the CFO of Shell, and Philip had made an apology to the shareholders as well as the public, and finally decided to resign in March 2004. The technique 2. Doing nice for someone to gain that person's approval. The evidence is the Shell agreed to pay fines of £70 million to the authority and $120 million to the Commission to resolve and support the two institution investigation into the oil and gas reserves. This is beneficial to Shell to establish a good cooperative image to the public, that it's brave enough to admit mistakes and actively correct them. The next technique is self-promotion, highlight one's best qualities. The evidence is, after months of external pressure from investors, rating agencies, and regulators, the oil group decided to push for complete restructuring of Shell, including a full merger, to restore the company's credibility. Shell intended to appeal to the public that it was determined to resolve the problem once and for all, and the leader of Shell can highlight their sincerity and confidence. The last technical words, they were used to highlight the achievement and play down the drawbacks. When describing the positive, as we can see, it used the words that are direct and clear to describe the achievement it made, which enable the readers understand its strengths once they see it. When it comes to the negative one, it didn't mention lots about that, and the description was relatively vague. That's all. Thank you.